Reconstruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
Backtesting is a tool that you will use as a trader or investor that you can use to explore new markets and new strategies. It can provide some super valuable feedback on the data that you have based on your trading activity. Now, it'll give you confirmation or invalidation if your trading strategy or investment strategy is valid. Now, regardless of the asset class you trade, backtesting doesn't require you risking any of your hard-earned funds either. Using backtesting software in a simulated environment, you can build and optimize a particular approach to a market. You can do this in Tradingview, but manual backtesting is just as effective. Let's get going. Now, what is backtesting? In finance, backtesting looks at the viability of a trading strategy by testing how it would have done based on historical data. In other words, it uses past data to see how a strategy would have performed. If backtesting shows good results, traders or investors typically go ahead and apply the strategy to a live environment. Now, what do good results mean in this case? Well, the purpose of a backtesting tool is to analyze the risk and potential profitability of a particular strategy. The investment strategy can be optimized and enhanced based on statistical feedback to maximize the potential of good results. Now, a well-conducted backtest can also provide assurance that the strategy is at least viable when implemented in a real trading environment. Anybody watching this video right now that's played sports, there's a reason why you practice before you play. You always want to make sure you know what you're doing before you suit up and get in the game. Now, naturally, a backtesting platform or tool can be also pretty beneficial in showing when a strategy is not viable or too risky. If the backtesting results indicate a suboptimal performance, the trading idea should be either discarded or modified. However, it's also important to consider the market conditions it was tested in. The same backtesting could present conflicting results when the market conditions change. Now, on a more professional level, backtesting trading strategies is absolutely essential, especially when it comes to logarithmic trading strategies, i.e. automated trading. So how does backtesting work? Well, the underlying premise behind backtesting is that what worked in the past may not work in the future. However, this can be really tricky to determine, and what may be profitable in a particular market environment will completely flop in another. Now, backtesting with misleading data can lead to less than ideal results. This is why it's crucial to find a good sample for the backtesting period that reflects the current market environment. This can be especially difficult as the market is in a constant state of change. Now, before you decide to backtest your strategy, it can be helpful to determine what exactly you would like to find out. What would make your strategy viable? Conversely, what would falsify your assumptions? If you know these beforehand, it would be much more difficult for the results to affect your biases. Now, backtesting should also include trading and withdrawal fees and any other costs that a strategy may incur. It's also worth noting that backtesting software can also be quite expensive, just as access to high quality market data is. And always keep in mind that backtesting is, well, testing. Similar to technical analysis and charting, there's absolutely no guarantee that your backtesting results will prove true, even if your backtest produces great results based on historical data. All right, so let's run through a very simple example so you can get an idea of what backtesting is so you can implement it when you create and develop your own strategy. Okay, so here is the trading system for this example. Say we buy Bitcoin at the first weekly close above the 20-week moving average. We sell Bitcoin at the first weekly close below the 20-week moving average. Now, this strategy produces only a few signals per year. Let's look at the time period starting from 2019. Okay, so we see the chart here. This is the weekly chart since 2019. The strategy produced 5 signals in the measured time frame: a buy at 4K, a sell at 8K, a buy at 8.5K, another sell at 8K, a buy at $9,000. So our backtesting results show that this strategy would have been profitable. Now, does this mean it's a guarantee it will continue to work? Absolutely not. It just means that looking at this specific data set, the strategy would have turned a profit. Now, you could think of this result as a rough benchmark. Now, keep in mind, we only looked at less than 2 years of data. If we'd like to turn this into an actionable strategy, it may be worth going back further in time and testing it with more price action. Now, with that said, it is a promising start, and the initial idea seems to be pretty sound, and we may be able to create an investment strategy from it with some further optimization. Now, maybe we'd like to include more metrics and technical indicators to make the signals more reliable. It's really all up to you. It's all up to your own ideas, investment time horizon, and risk tolerance. Now, you might have heard of paper trading. We did discuss it a bit in chapter 1. Let's go ahead and compare and contrast the differences and similarities between backtesting and paper trading. So in chapter 1, we did briefly discuss what paper trading is. It's basically just practice trading, trading without risking any of your capital. And now that we have a rough idea of what backtesting may look like and how to look at a very simple investment strategy with backtesting. Now, we also know that past performance is not indicative of future results. So how could we optimize a systematic strategy for current market conditions? Well, we could try it out in a live market, but without risking real funds. This is also known as forward performance testing or paper trading. Now, paper trading is the simulation of a strategy in a live trading environment. It's called paper trading because while the trades are documented and logged, no real funds are used. Now, this provides you with an additional step where you can improve the strategy and get an idea of its performance. Now, that's great, but where can you actually start? Well, there's a few different places you can go. You can do paper trading on the ByBit testnet. There's also the Binance Futures testnet, and there are a few others out there that you can use as well. But they all work, and they all will help you develop your strategy and help you with proving its viability. Now, you can create an account with Binance Futures in a matter of minutes, the same with ByBit. Now, something to be worried about here is cherry picking. So this refers to selecting only a subset of data to confirm a biased viewpoint. Now, the point of forward testing is to test out a strategy as if it were happening in real time. Now, if the system tells you to do something, do it. If you only pick trades that look good based on your personal bias, then the test for the systematic strategy won't be valid. Now, you can backtest your strategy in a number of different ways. 2 of the most common are manual and automated backtesting. Manual backtesting involves analyzing charts and historical data and manually placing the trades according to the strategy you've developed. Automated backtesting essentially does the exact same thing, but the process is automated by computer code or script, and you can do this in Tradingview. Now, this course won't go over how to backtest a strategy in Tradingview. Instead, we will go over how to do this manually. Now, many traders will use Google or Excel spreadsheets to evaluate the performance of a strategy. If you scroll to the top of this chapter, you will see that I've created a trading log, trading journal for you to use in the event you would like to go back and backtest your potential strategy. You can log all of the potential trades in this trading log. Now, these documents work like strategy tester reports. They may include all kinds of information such as the trading platform, asset class, trading period, number of winning and losing trades, Sharpe ratio, maximum drawdown, net profit, and more. So drawdown is, say if you entered into a trade, say you bought Bitcoin at $32,000 and the price dropped thereafter down to $27,000, your drawdown would then be $5,000 before the price started to rebound and recover past 32. So your drawdown is how much your trade goes into the negative before it goes back into the positive. If your trade goes into the negative and hit your stop loss, that's not a drawdown, that's just a loss. Okay, so in short, Sharpe ratio, it's used to evaluate potential return on investment of a strategy in relation to the risk. The higher the Sharpe ratio, the more attractive the investment or strategy is. Many systematic traders or logarithmic traders and investors heavily rely on backtesting for their strategies. It's one of the essential instruments in the toolkit of any logarithmic trader. Now, a logarithmic trader is really just someone that uses a set of metrics to confirm or deny their trade. So if A happens, then you will do B. If B happens after A, then you will do C. I hope that makes sense. And at the same time, interpreting backtesting results can be pretty tricky. Now, it's easy to imprint your own confirmational bias into the backtesting method. So backtesting alone likely won't create viable trading strategies, but it will help you test some ideas out and keep your finger on the pulse of the market.